Hey everyone and welcome back to the channel. Today we are cracking open the Alibaba earnings report and let me tell you, it's a shocker. The stock price is plummeting, down 7%. Hold on a second though, before you panic sell your shares, there might be a silver lining in this whole mess. Here is the thing, the report wasn't all bad news. Alibaba is actually still growing in some key areas. The big question is, can this good news outweigh the disaster? Can Alibaba bounce back, or is this just the beginning of a bigger fall? In the next few minutes, we are going to dissect this report, uncover any hidden opportunities, and tell you whether Baba stock is a burning dumpster fire or a golden ticket waiting to be cashed in. So buckle up, hit that like button and subscribe for more no-nonsense stock analysis. We are about to separate the fear from the facts and help you decide what to do with your Baba stock. Let's start with the news. Alibaba's shares fell 7% after the tech giant posted 86% drop in profits. Actually, this report, Alibaba revenue was a bit better. Their net income came at 3.3 billion yuan, down 85% year on year. That is the reason this miss on their net income, and investors are really worried about that. Actually, that is bad, especially when Alibaba, one of their key strengths has been their profits. They are trading at a cheap valuation and making a lot of money. They are recovering their profitability, but this quarter was bad because of that. But for me, this is just my opinion. Revenue came in line, they reaccelerated their growth. Revenue was 221.9 billion yuan. It was expected to be around 219.6 billion yuan. It is a bit around 1% around that, which is not bad. That was good growth, and for me, beating on revenue is far more important than beating on earnings. So for the long term, or for a long-term investor, seeing this company beating expectation on growth, it is really good. So it was a good point on Alibaba earnings report. From that, they reported as well that their cloud segment continued to grow, but low single digit. But when it comes to AI, they are growing at triple digits, above 100%, which is good news as they have already been reported. Let's go to the earnings report. Let's start with the words of Eddie Wu, the CEO of Alibaba Group. This quarter's results demonstrate that our strategies are working and we are returning to growth. Our China and international commerce business realized double-digit year-over-year GMV, gross merchandise volume growth, through our focus on the customer experience. We are also excited by the accelerated growth of customers and cloud computing revenues related to our AI products. We will remain focused on our strategic priorities and capture future growth opportunities. This is not recent news. We have seen a lot of press releases and interviews from top management of Alibaba. They are saying they are investing in the company. So this loss in profits are due to investing in their future. They are investing a lot in their cloud, which is where they need a lot of capex, for example. So, but seeing a company with the quality of Alibaba investing in the company, it's really good, because my money or the shareholders' money are better invested in the company in a growth market than if it is us to invest. So I think that is what should be done, and I'm with this decision from the CEO of Alibaba. So I think it is good news, even though at first glance it doesn't seem so. Alibaba Group delivered a strong quarter with revenue growth of 7% year over year. I take that 7% growth is really good. in my opinion, of course. We are not expecting to see a company as big as Alibaba growing 15 or 20% anymore. They are not a small cap anymore. We have seen early results from increasing investment in our strategic business priorities and are confident in our business outlook. We are committed to continue to return value to our shareholders. This is very important. One of the key factors I look into a company to invest is the return of value to the shareholders. It can be buybacks, it can be investing in their own business and making the company grow and their future earnings grow as well. But there are a lot to do. Board of Directors has approved the 4 billion dividend for the fiscal year of 2024. Business highlights 7% year-on-year growth. I'll take that, really good. Net income was bad, primarily attributed to a net loss from our investments in the publicly traded companies during the quarter. Guys, it was a miss on their profits or on their net income because of they write off their investment in publicly traded companies. If you follow the Chinese market, January to March, there was not good news on the market. Chinese stocks were down, so it's normal for the stocks or Chinese stocks or companies that Alibaba is investing in to be down. So this is the reason why Alibaba stock or the net income was down for this quarter and for fiscal year of 2024. So this is good news actually. Even though this looks bad for Alibaba, this is justified in my opinion. But even though the first 3 months of the year was not really great for China, but since that April, May has been really good for Chinese stocks. We have seen reports from Chinese economy that manufacturing, they are doing great. Exports and imports are increases, so there has been a lot of good news, and I'm expecting the next report for this April, May and June quarter to be really good actually, guys. For the fiscal year, we have seen in 2024 an increase 8% year over year, really good growth. Net income and free cash flow has been in line with the previous year, which was not bad. Even though Alibaba is cheap, so they are continuing to make money, and we are seeing a net income yield or a free cash flow yield really high. So another thing I like to see is the growth in the different segments of Alibaba. Taobao and Tmall grow 4% year on year, and for the year 5%. Cloud growth in this quarter of 3% year on year comparison, and for this latest fiscal year it was a growth of 3%. International commerce has been really good, 45% growth. Cainiao or Cainiao is growing around 30%. Local service 19%, and the rest we can ignore far less. All others, it is a miss, they are not growing, but it is a big percentage of their revenue, so we should talk about that. Net income this quarter was really bad, only 919, and last 3 months when you compare year on year it was 22, but this year actually was better. We have seen even though this quarter we have seen barely no profits, for the year we had seen a growth of 9%. If this quarter came in line around I don't know 20 billion yuan, it would be a 40% increase year on year for this 2024 year. So next year, if they continue to grow, I'm expecting a big jump on their profitability. So it's just a quarter that was a miss because they have to write off some publicly traded investments. So what? I'm continuing to be a lot optimistic. Share repurchase, they continue to do their share repurchase. They bought a total a lot of shares this latest quarter. Let me see, 4.8 billion, which is a record for the 2024 year. Totally, they reduce shares in 5.1%. This is really great. If they continue to do that, it will add a lot of value to the shareholders. Dividends, they have issued in the previous quarter annual dividend that will continue. That was $1 per share in the ADR, but now they issued another special dividend of 0.66 cents on the dollar. So they are continuing to distribute money and profit to the shareholders, so continue to do great. They have a balance sheet that is spectacular. I love that they basically can pay all of their debt and still have a net cash position of let me check, of around $65 billion. This is huge, and they are using that money to invest in the company to reaccelerate their growth and increase the future profits. It is a check, really a great job. They are doing a lot of buybacks, and besides doing buyback, they are buying back shares at a cheaper valuation. That is when it should be done. So spectacular move. And since they have a lot of money, they use their money to invest, to do a lot of buyback, and still they have plenty of money. So they are paying some dividend. They are distributing some money to the shareholders. What should you ask more from Alibaba? So Alibaba is a great company for me, one of my favorite investment. It's all check marks, what you should look in a company. Continue to growing, trading at a cheap valuation. Even though I do a conservative analysis, my fair value is around $130. They are trading right now at $78.5, which is a margin of safety of around 40%, which is great. Of course, I'm using a discount rate that is huge, so I can have plenty of margin of safety already implemented on my fair value, because it is China. It is a medium risk, I would say, to invest in a company like Alibaba. So my base case, I will use a discount rate of 14%. Even with that margin of safety already in the discount rate, I'm still Alibaba stock is still trading above their fair value by a lot. It is a lot of margin of safety. And after this earnings report that look really bad at first glance, but if you look with your eyes and paying attention, it was a bit on revenue. They are growing above expectation. Their net income was bad because they publicly traded some stocks, and that was losses on that investment. So that's why they didn't have a lot of profits when compared to previous quarters. But even with this null quarter, I would say that they have no profit. This latest year was better than last year, 9% better, basically with just only 3 quarters. So next year, if they continue to grow, still recover their profitability, I'm expecting them to do a lot of profits and free cash flow as usual. I would say continue to do what they should do, investing in a profitable business like AI and cloud and international markets with AliExpress, for example. Continue to repurchase a lot of shares, doing a lot of buybacks, and even though with a lot of cash in hand they are paying dividends, I'm really happy to be a Alibaba shareholder. So this is my take on this latest earnings report. I hope you like this video, guys, and please like and subscribe. See you next time.